Millions of people are paying more for their loans than they actually need to, and most of them don't even realize it. Refinancing isn't just a finance trick for experts or homeowners with massive mortgages. It's a money move that can lower monthly payments, cut years off a loan, or save thousands in interest, but only if it's done at the right time for the right reason. The problem? Most people either refinance too late, refinance for the wrong reasons, or avoid it completely because it sounds complicated. The truth is, refinancing can be one of the smartest financial decisions you ever make, or one of the biggest mistakes, depending on a few key factors that almost no one talks about. If you've ever wondered whether you should refinance your car loan, student loan, mortgage, or personal loan, this video may change the way you look at debt forever. Because sometimes the best way to get ahead isn't earning more money. It's stopping the money you already have from leaking out. What refinancing really means and why people get it wrong. A lot of people hear the word refinance and instantly think it just means getting a lower interest rate. But refinancing is actually much bigger than that. It's not just about saving a few dollars today, it can change the entire structure of your loan. When you refinance, you're basically replacing your old loan with a new one. Same debt, new terms. That new loan might have a lower interest rate, a different monthly payment, a shorter payoff period, or even a longer one depending on what you need. The problem is, many people rush into refinancing because it sounds like a smart move, but they don't really understand what they're changing. They see lower payment and assume it's good, but sometimes a lower payment just means you're paying for more years, which can cost more in the long run. Others refinance only because everyone else is doing it, without stopping to look at what it does to their loan, their budget, and their future. So before asking, is refinancing smart? The real question is, what are you trying to fix? Are you trying to save money every month? Pay off the loan faster? Lower your interest rate? Or just feel less pressure right now? Once you understand that refinancing isn't just about rates, but about strategy, you can start to see when it's helpful and when it's not. The big green light. When refinancing actually saves you money. Refinancing can be a smart move, but only when the numbers actually work in your favor. The biggest reason people refinance is to lower their interest rate, because even a small drop, like from 7% to 5%, can save thousands of dollars over the life of a loan. But the interest rate isn't the only green light. Sometimes refinancing makes sense because your financial situation has changed. Maybe your credit score improved, you got a better job, or you've paid off other debts. When your money situation gets stronger, lenders often offer better terms. Another good reason to refinance is if you want to shorten the loan term, for example, turning a 30-year mortgage into a 15-year one. The monthly payments might be a bit higher, but you'll finish the loan in half the time and save a huge amount in interest. Or maybe you want the opposite, a lower monthly payment because life got harder, maybe income dropped, or you need more room in your budget. Refinancing can stretch the loan out so your payments feel easier, even if it means paying more interest over time. The key idea is this: refinancing is smart only when it lines up with your goal. If the goal is to save money long-term, the numbers should prove it. If the goal is to breathe easier month to month, the payment should feel lighter. Refinancing is not about what sounds good, it's about what actually benefits you on paper and in real life. The hidden costs most people forget to check. A lot of refinancing mistakes happen because people only look at the new interest rate and ignore the extra costs that come with it. Almost every refinance has fees, sometimes small, sometimes large enough to wipe out the savings completely. These fees may include application fees, loan origination fees, closing costs, early payoff penalties, and even credit check charges. Many people don't find out about these until they're already deep into the process. For example, if refinancing saves you $80 a month, that sounds great. But if the refinance costs $2,000 in fees, it will take 25 months just to break even. If you don't plan on keeping the loan that long, you're actually losing money. That's why smart refinancing always includes a break-even check. Another hidden factor is what refinancing does to your loan timeline. A lot of people refinance after a few years into a new 30-year loan. That means they start the clock all over again and end up paying interest longer, even if the monthly payment is smaller. There are also emotional traps. Some people refinance because they want a break financially, not because the math makes sense. Others panic at the word fees and refuse to refinance, even when the long-term savings outweigh the cost. The lesson: refinancing only pays off when you count everything, not just the rate. Before saying yes, ask, how much will I save, and how much will it cost me to save it? Refinancing. Different types of loans. Not all debt works the same. Refinancing isn't a one-size-fits-all move. A mortgage refinance is very different from refinancing a car loan, student loan, or personal loan. That's why the decision depends not just on your situation, but also on the type of loan you're dealing with. Mortgage refinancing usually involves larger savings, but also bigger fees and longer paperwork. Because mortgages last so long, even a small rate drop can save tens of thousands of dollars, but the closing costs and time commitment are higher too. Car loan refinancing is faster and easier. If interest rates have dropped or your credit score has gone up, you may be able to lower payments in just a few days. But car loans don't last long, so the savings window is smaller. Student loan refinancing can reduce interest and speed up payoff. But if you refinance federal loans into private loans, you may lose protections like income-based repayment or loan forgiveness, so the savings might cost you important benefits. Personal loans are often refinanced when someone's credit score improves. Since these loans have higher interest rates, the savings can be big, but only if there are no heavy penalties for early payoff. The reality check: should you refinance or just stick to the plan? At the end of the day, the smartest refinancing decision isn't based on what other people are doing. It's based on your own numbers, goals, and timing. Before you rush into refinancing, there are a few personal questions that matter more than any interest rate chart. First, how long will you keep the loan? If you're only staying in your house or car for a couple more years, it may not be worth refinancing unless the savings kick in fast. Second, can you handle the fees right now? Even if refinancing saves money long-term, the upfront cost may not make sense if your budget is already tight. Third, what's your real goal? Lower payment, faster payoff, lower interest, or just less stress? Refinancing can't do everything at once. You have to choose the benefit that matters most. Fourth, is your credit score in the right place? A high score unlocks better rates. If your score is still low, waiting and improving it may save more money than refinancing today. And finally, are you trying to escape the loan or manage it smarter? Sometimes people refinance to avoid feeling trapped, but end up stretching their debt even longer. Refinancing is not about being clever. It's about choosing what truly makes your financial future stronger, not just easier today. Before you go, take a second to think about what we covered today. Refinancing isn't just about getting a lower rate. It's about choosing the loan that truly supports your goals. We talked about what refinancing really means, when it can save you money, the hidden costs people forget, how it works for different types of loans, and how to decide if it's the right move for you right now. The smartest choice isn't the one that looks good on paper. It's the one that fits your life, your timeline, and your future plans. Thank you for watching. If you found this helpful, please hit the like button. It lets YouTube know this content matters. And don't forget to subscribe for more valuable insights on money, loans, credit, and smart financial decisions. There are more eye-opening topics coming soon, and you won't want to miss them. Stay curious, stay informed, and I'll see you in the next video.